I mean, I think that's a hard question to answer. I think, you can go like marketplace by marketplace and say, machine learning and computer vision is a thing. So there's going to be opportunities there. I think the good thing about our fund is that we invest in across every entry point, all the way to public and growth as well. And I think we see opportunities in companies that have already been there. Some of them have been overfunded, but now they've been given the time to start maturing in their market, maturing in their customer base. So a lot of what we've been doing is actually kind of go back to the drawing board, taking a holistic approach and say, we're just going to go after good companies with a good market, no matter what that is. So I think without naming any specific companies, with some of our competitors here on the stage, I think marketplaces are great at the end of the day because they're self-sustaining, and what you typically do from any, at least at the earliest stages, you define companies as either bounded or unbounded. Bounded meaning that you have some sort of public comp that this company could be parallel towards. So B2B and enterprise is easier to do that because you kind of see what that life cycle looks like, how long it takes to get your customers, so on and so forth. And on the consumer side, or even in space to a certain extent, those are more unbounded opportunities because we don't know what the market will look like. So we actually spend more time in those areas, and a lot of people have called it frontier, or semiconductor, or quantum computing, et cetera. So we actually spend a lot more time, and we have a team sort of dedicated to looking at these areas where most venture capitalists won't spend the time.
Yeah, I think the point around funding adjustment is one that we're thinking about a lot. So again, it's less around a specific technology trend and more that there's been somewhat of a rebalancing of activity and capital flows, which can create, in our view, a different and more attractive risk return for companies that are in interesting spaces, doing well, but maybe a year or two ago when funding was at a more elevated level, in our view, didn't present the right risk return. And now we're seeing instances in a lot of pretty high profile scale companies that have now come back into a valuation zone or a multiple zone that we now think is pretty interesting. And by the way, now you've got 2 more years of data that you can look at and get confidence. The management team has matured, and so that profile of investments, something that we're looking more and more at these days than we were 2 years ago.
Maybe to just take a different spin on the question, one particular thesis we have, or BVP, that I've been pushing is around the future of entertainment and the future of where we get our media consumption. If you think about it now, so much of the way we consume entertainment, at least in the US, is through through cable operators and networks, through folks that control the access to delivery of what we consume as consumers, and that's completely changing in terms of our time and attention. And so I think it's not a contrarian thought at all. I mean, lots of people are sort of looking for what are going to be the online first distribution models for the future of entertainment. But I think it's just getting going. If you look at the ad dollars, you look at the amount of time folks spend with media, we're still 80% geared towards traditional media. And that's starting to now finally accelerate to where online is catching up and may cross in the next 4 or 5 years. But that trend is not fully played out yet. And there's going to be a lot of Snapchats and YouTubes and Vivo and Hulus that develop as a result. And I think it'll present opportunities for big companies to innovate as well as startups as well. So that's one of the areas where I think there's the most opportunities. I just look sort of across different sectors and think about where should we be spending our time and investing our capital.
So many people globally have noted a change or like a possibly investing going down or a changing trend in investing. Is that true, or is it #fake news?
Well, no, I think if you look at the macro picture, it's not fake news. It may be exaggerated a bit. I think what generally happened in broad terms, if you step way back, what you tend to see sort of roughly 7-8 years cycles in terms of startup investment capital. The sort of venture ecosystem tends to have some cyclicality to it. And so if you look over the last sort of 4 to 5 years, we got to a point where there was a ton of investment in really converging on a couple of different themes where companies that had a couple different specific parameters people were chasing to put as much capital as they could possibly put into those different sectors. And so you had a lot of companies that were just overfunded and a lot of sectors that were just overfunded. And I think folks have woken up from that and seen, kind of done the math on what, you know, how this is likely to end when you look at where public markets and the other markets were trading, which were much more rational in terms of multiples and valuation philosophies, and seen that this wasn't going to end well unless we pulled back a bit from some of these companies, or at least invested on sort of more rational bases. And so you heard Arjun and Nathan speak a little bit about, you know, fundamentally good companies that maybe were overfunded or overvalued, but now are interesting again because they sort of finally caught up to where the market valued them. I think that waiting period did create some pullback on a macro scale, and a lot of the sort of higher priced unicorn rounds for companies that weren't necessarily fundamentally sound, those are a lot harder to get done now. And sort of the next tier of companies that really haven't figured out, they don't really have product market fit, or their unit economics don't really foot, those companies are sort of impossible to fund. And so the result of all that is a little bit of a pullback. Not quite as exaggerated as maybe some of the articles predicted, but it's there and it's real.
I think what you see is, you know, there was less money just going in at the later stages more than anything else. And I don't think you saw too much difference in the seed. I don't think you saw much difference in the pre-seed and much difference in the Series A. And Series A valuations haven't really changed too much on an average. Obviously, there's always these outliers depending on the companies. And then the other fundamental shift, I think, if you just look back 5 to 8 years, is that you know, when a company first started raising capital, they'd raise, you know, let's just say $500,000 to $1 million. That would really be borne by, like, you know, a couple of angels and maybe like one seed institution firm, as you'd call it. And then the next tranche now is by 3 seed institution firms, which I would say, you know, 10 years ago was one Series A firm trying to take 20%. And so a lot of that risk has changed. And so what you've seen, I think what you've seen is a lot of the Series A/B firms trying to figure out who they want to be. And then a lot of the later stage firms trying to figure out where do they want to play. Do they want to come back a little bit earlier? So like Series A firms have become Series B firms today, in my opinion, more momentum investing. And a lot of the seed firms now, 3 or 4 of the firms will take the place of one firm at the Series A. And so I think what you're saying is also a shift in the dynamics of venture capital, where can you really call yourself early stage venture capital or a Series B sort of growth sort of capital firms. And I think that's been a part of it. A couple of companies getting the majority of the capital, you know, a la Uber and Snapchat. So I think, you know, when I read an article that goes over these averages, how much capital has been deployed, you can kind of just put 5 companies on that list and say, well, majority of that capital went to these companies.
Yeah, I'd maybe layer on a longer term view to this. I think we're talking a lot about what's happening over the next couple of years, and there's certainly a lot of interesting things going on. One other question is, well, what happens after that? And I think certainly over the past 2 to 3 years, there's been an increasing and self-reinforcing cycle of capital flows from limited partners coming into general partners, and that increased capital has created good returns, which has created an appetite to give more capital. As there's been a slight readjustment in that, there's still an incredible amount of unrealized returns sitting out there. And to me, a really interesting question is what will happen with that? I mean, I think, Ethan, you sort of alluded to it with the kind of IPO overhang, or how is this going to turn out? And I think that will have an implication on what capital flows into this space will be years 4, 5, and 6 from now, because either things plus or minus will work out, and it will continue to be a really attractive asset class for people to put an increasing amount of money in, or we're going to see some lack of return, at least on average, for that those set of unrealized returns now, and I think you may see a longer term pullback.
All right, awesome. Thanks, guys.
Thank you.